Evening, ladies and gentlemen. This is Tech Group second quarter 2023 analyst briefing. This is Peter from the investor relation team. As usual, Rohit and a few members from the senior management team will go through the presentation. So during the presentation, please keep your line muted. And with that, I will pass the floor to Rohit for his presentation.
Hello everyone, I hope you can hear me clearly. Thank you. We just announced the results and I hope some of you got time to quickly look at it. We're happy to announce our third quarter results. As you all know, early part of the quarter we announced our 7th airline partner, a very material airline partner, VHA. We have reported stronger net profits in the quarter from sustained investment performance, but also on the back of better underwriting performance as well. So let me delve deeper into the 8 commitments we have made. And I think overall we are seeing that 5 areas we are on green, on 3 we remain on work in progress, but we remain committed to delivering on our 2023 promises by the end of this year. At which point we will announce our new 2026 commitments. So no changes to the plans. Excluding the 2022 one-off from Penang, we registered actually healthy growth across all 3 pillars. Actually, if you look at the numbers, overall our retention rate is now 75% in second quarter, which is also great news, and it shows that our preferred segments, health and lifestyle retention, is above 70%. Yes, SME is hovering around 60s, but also sometimes it's a timing effect of the kind of products we sell. Our motor strategy is definitely yielding positive results. We are seeing better retention. We are also seeing more favorable segments on the back of our data strategy, repricing, which we talked about. So clearly our motorcycle and higher value motor segments are driving better performance. There is definitely some catch-up work to do for SME and also for the other segments in the second half. We made a full exit from a low retention large commercial account by the end of 2022, which we had announced to you. Last year, we already told you we want to do renewal, and obviously this year it's fully run off. And this is something we are continuing to focus on. Excluding the Penang scheme, which was a one-off government scheme last year, our NWP is up 14%, which means our steady state business is up 14%, but we hope to continue to dial that up in line with our commitment, which was we want to grow between 25 to 33%. If without Penang, our NWP would have been up by 4.6%. Majority of the Penang scheme premiums were booked in 1H 2022. So there's very little left in the third and fourth quarter. In fact, third quarter has 0.5 million only, 0.5 million. Our 2Q23 travel premiums are higher than 1Q. Sorry, I meant the quarter of 2019, which tells you we are finally showing a growth over 2019. In fact, July, AirAsia had their first month of growth versus COVID. Of course, pre-COVID levels, we were growing 3x as we mentioned, but versus pre-COVID levels, July was our first month of growth, July versus July 2019. And what we are seeing is that clearly travel is coming back, and obviously the price increase is also helping. Motor NWP is up by 42% year on year, driven by our strategy. But again, there is more on this in the combined ratio, and you will see that this is something overall we are seeing a good growth on the lifestyle segment as we acquire more Gen Z and millennial customers. Moving on. We welcomed several new partners in this quarter. More importantly, but all the others are important, is VHA. We went live on 5th July. Honestly, it's 3 months behind our schedule for many reasons, but It's been a great win for us. We also have another win where we're starting to distribute critical illness in Cambodia. And we're also doing other programs with Access and Astro around lifestyle and PA cover. Um, if we exclude Penang again, our partnership business grew by around 10.7% in the second quarter. And this we will continue to grow, and it will continue to replace Penang as the year goes by. And I think I did talk about it won't be a one-off because you don't have one account which can just replace it. It has to be a gradual process of replacing it. The top five partners contributed about 48% of our premium, which tells you it's not like some companies where 80% is dependent on a few partners. But the team is now really focusing on driving sales with these partners. Our combined ratio is lower by 9.9%. This is on an MFRS 4 basis. We do provide an IFRS 17 basis later, and I know that's what you want to hear because obviously the financials are no more based on MFRS 4, but we want to be consistent with you, so we're talking about this, but we will gradually move towards IFRS 17. In fact, on IFRS 17 basis, it's below 100%. Our combined ratio improved by 9.9%, despite the investments we are making in white label, the life sandbox business, and also the large tech change that we are making. This was definitely helped by better claims experience on the back of PA, motor, and travel, but also on the back of the fact that yes, our ME has grown, but it was primarily driven because we had to make some material investments, which we've talked to you about on tech and data capabilities. Overall, our combined ratio year on year has also started to reduce, and we feel based on the Q2 reduction, which is even more material, Q1 was, as you remember, less material. This is very positive for us. Tech, white label is a critical part of our organization. We recently went live in Nigeria with our first African go live. We have the largest travel distributor live in Nigeria, and we are working on 9 countries as we speak. We have a partnership with one of the largest distributors in Africa. So we will be working with them to activate newer markets. I will talk about that probably over the next quarter as these deals are announced. We will give you more details, but it's something that we've announced one market, but as multiple markets announced, we'll give you more information on that. Salam Air has been renewed for another 3 years, and VietJet is powered by white labels technology. You'll be happy to know that your company has also won the 23rd edition of PC.com for Best InsurTech. And this was solely by customer polling. It also tells you further that customers like what we give them. We are expanding in Vietnam. You saw our business last year in Vietnam was growing quite a bit on the back of e-wallet, on the back of payment gateway, on the back of e-commerce. We had quite a few partnerships and a ride-hailing taxi. Now we have our 6th partner in Vietnam, which is VietJet, who have around 400 flights daily. They carried more than 80 million passengers daily. The first market that gone live is Vietnam for bundled insurance. It's called SkyCare, and also comprehensive insurance, which then the customer buys for, which is travel safe. Bundled, they bundle it with every ticket. Countries that are part of expansion scope include Thailand, Malaysia, Indonesia, and East Asian countries such as Korea, Taiwan, Japan, China, and India. So we will activate markets one by one. And these are VietJet's top markets, and we will focus on markets which have higher passenger volume in terms of execution. We are constantly growing on our customer count, on our app downloads. And now I'm going to invite Jubin to say a few words on the next 3 slides. Jubin? Yes, please. Yes, please. Okay. I think we also have done exceptionally well on the regional customer NPS score. We have the latest scores, which was just out of the, in June this year. Our customer NPS score has moved to plus 43. And with this, we are better than global industry benchmark and a leader in our preferred markets. So you should be very proud that the strategy we have implemented is starting to show clear benefits in terms of how the customers perceive us, and this is something we are continuing to drive, and we will keep pushing it. It is very similar to what Lemonade tries to do: build the company based on customer satisfaction. In terms of customer tracking, yes, a number of unique active customers in 2Q was lower, but that's because 2Q last year had Penang, now it doesn't. Nonetheless, there's some very interesting statistics here. Our average active policy per customer, which means the policy number per active customer, or the product that the customer is buying, or the vintage, or the average premium, have all gone up, which tells you that your company is starting to attract customers who are buying more from us and staying with us. And one such example you heard from Jubin was Pump, where 20% of Pump users, or even more, they're buying policies from us, and we are making new premium as well. Significant improvement in our employee NPS. Our employee NPS has now moved to plus 28. We're working with a lot of universities in making this organization a much more younger, leaner, fitter, faster organization. And as you can see, we're hiring a lot more Gen Z, which also means your cost per employee should eventually come down, but not at any quality difference at all. In terms of our ESG commitments, we're making good progress in each of our ESG commitments. We have aligned our management of climate risk and opportunities to BNM's policy document. We're expecting to launch our digital life product for unserved segments by Q4. Our employees have completed 59% of targeted CSR hours. And as you know, our women in leadership at board and management is at 50 and 41% respectively. Overall, my message would be it's been a very strong quarter, and at the base, if you take Penang out as a one-off business, we are seeing business coming around, and I will now hand over to Hao for the financials. Hao.
I think this slide basically we just go back to is basically just repeated our previous quarter. So we understand that basically the analyst will still prefers 4 result, but nevertheless I think it's also quite quite heavy in terms of workload trying to present I think both 4 and 17s I think to the analyst. Internally, we are actually looking at slowly switching over to MFRS 17's result, I think hopefully by next quarter. And our IR team will also be coordinating these sessions with the investor analyst, hopefully in the coming months, so that we can actually have these sessions to explain our conversions into MFRS 17s and to help basically the analyst communities to get ready for us switching towards 17s for our analyst deck moving forward. Yeah. Next slide. I think next slide, I just want to go through the financial performance.
Oh, it's taking time.
Oh yeah, it's a bit slow. I think mine also. Okay. I just want to go through, I think, briefly on the financial performance. I think after what Rohit have actually shared. On the net return premiums level, year on year, you notice that our second quarter actually declined by approximately 21%. As I think what Rohit already explained, in quarter 2 last year, we do actually enjoy a big influx of Tenang PA's premiums in second quarters of 2022, amounting to approximately 35 million in that quarter alone. Nevertheless, at the NEP levels, we have actually shown a year-on-year growth of 8.5%. That predominantly was contributed by a strong motor growth in the second half also of last year, and got continued growth in 2023 as well. Underwriting contribution line, you will notice a significant improvement from 11.8 to 36.1 second quarter of 2023. That mainly contributed by a significant improvements in the claims experience, what we see, especially in 2 main segments. I think more in motor, our motor claims experience, as well as basically PA line. Motor claims experience, basically, after the repricing end of last year, we started to see a significant improvement in our claims experience. That resulted in the revisions, I think downward revision of our ultimate loss ratio by the actuary for both 2022 and 2023 years as well. Underwriting profit line in quarter 2 23, we actually marginally exceeded, so we are still actually recorded a loss of 2.4 million. But taking into considerations that we do actually have a sizable amount of group costs, which we are a bit different compared to the other insurance companies, because we are not just actually an operating company that run insurance. We are also having holding companies that basically runs a tech as well as our venture into digital life as well. So, I mean, that was actually also linking back to what Rohit was sharing. If we were to show a combined ratio, I mean, under 17s, where non-insurance attributable expenses was recognized under other operating expenses. If we were to look from the angle, I think our combined ratio, which may be more comparable with other insurance company, will be actually below 100%. Moving down, I think our net investment income, you also notice a significant improvement from a loss of 6.1 million to 8.7 million gain. Our YTD positions, basically total investment return recorded 18 million returns first half of 2023, which represent approximately 5.2% per annum return for the first half of 2023. Share result, during the quarter, we also noticed a significant improvement in share result, predominantly contributed by Tune Protect Thailand. If you still remember, second quarter of 2022, our Thai company do suffer significant claims deteriorations due to COVID situation in Thailand, which subsequently, in the subsequent quarter, we see significant improvement. we see the situation in Thailand stabilize. In quarter 2 2023, Thailand recorded a marginal break-even of 100,000 based on our share of 49%. This quarter also, I think there's a unique situation that you will notice that in our 2Q 2023 MFRS 4 PAT, which was actually for 7.1 million. If we were to compare to what we actually reported in our Bursa statutory report, our MFRS 17's PAT actually recorded at 11.2. In the subsequent slide, we will share with you some of the abnormal item, or what we call one-off items, that we actually have encountered during this quarter, which actually resulted in a significant gap differences between the two different standards, which under normal circumstances, it should be relatively small. Yeah. If we can move to the next slide. Okay. Yeah, maybe I pass to our actuary to run this thing through so that she can explain to you what were the significant abnormal items that actually taken place in the first half of 2023. Yeah. All right.
Thanks, Hao. This is Chongqing. So as you can see, the MFRS for 2023 first half, the MFRS 4's PAT is 10.5 million. 17 is at 14.4 million. There is a 3.9 million gap in terms of PAT. As Hao mentioned, this arises from two main factors. So the first factor, the 1.3 million, is quite straightforward, where basically there is a revision to the risk adjustment subsequent to alignment with the auditor as well as market practice on the computation of risk adjustment. For the second factor is basically a technical difference between both reporting standards. So under existing regime, the insurance reserves are estimated at the company level. What this means is that, for example, if there is two classes, one is profitable, one is loss-making, under existing regime, the profit from the profitable class can be used to subsidize the loss from the loss-making class. Whereas under MFRS 17, the estimation of reserves is at a more granular level. So in this example, the loss-making class will be reserved separately from the profitable class. As such, just with this, we should expect higher reserves required to be held under MFRS 17. So this phenomenon is actually exacerbated by this COVID-19 health product, where it is abnormally highly loss-making. Right. So as such, we will have to hold a much higher reserve. In 2023, under MFRS 4, claims experience has been better than expected, so we have released some reserves from this COVID-19 health. So for the same reason, the release is then magnified under MFRS 17, which has resulted in this additional 1 million profit. Excluding these two factors, the MFRS 17 impact for us for first half 2023 is 1.5 million.
Yeah. Thanks, Chongqing. Just to add on to that, so in short, I think predominantly, I think we currently already engaged EY being our auditors. They are actually reviewing our quarterly result. I think effective from quarter 1, with a special focus on MFRS 17. So I think like what Chongqing shared on the first bullet point, alignment on risk adjustments, that was also triggered from our auditors. Basically, that was sharing the market practice by the other insurers practice, and they were sharing with us in quarter 1 that they think we could be rather conservative relative to the market practice. Hence, we are also aligning our practice to be closer to the market in terms of alignment of the risk adjustments practice with the other industry player. Okay, whereas the second one is predominantly contributed by the Thailand situation, which I explained just now, a significant COVID provision in last year, and also a significant releases actually that we are seeing in this quarter. In the next slide, basically, this basically show you the investment portfolio. As you can see in the diagram, in the pie chart, so second quarter 2023, 97% of our investment portfolio are all in unit trust funds, with 75% of it actually invested in money market funds, and the remaining, I think, in fixed income funds, 2% I think in deposit. Currently, I think, as I shared just now, our overall return, I think for first half, is actually an annualized return of 5.2%. And specifically on our money markets funds, the annualized yield is at 3.7%, I think first half so far. With the, I think, increasing, I think, UPR rate, I think we do see that basically we actually benefited from it, I think, in our quarter two. That actually kind of create a lot stable investment incomes, I think, for the group in the coming 2 quarters as well. Okay, then I pass it back to, I think, Rohit.
We're doing the usual comparison. So we remain the only profitable insurtech on the other big ones in the world, although they still command a significantly higher multiple than us. But I think key messages for everyone today is the following from our perspective. One is travel is coming back for sure. We expect to continue benefiting from the travel activities. Our motor book is a lot more stable. I did tell you Q2, Q3 was an anomaly. You have seen Q4, Q1, Q2, now 3 quarters where motor has looked much more healthier. We are seeing upsell, cross-sell ratios improve, as you saw with the 1.41 number that you saw. So we are selling roughly 25% of our motor policies sell PA policy. Roughly 20% of our pump users are also buying policies from us. So it's clearly an area of focus for us. Our investment returns have stabilized and is expected to deliver favorable returns. On MFRS 17, we understand some of you may have questions. We are proposing to have more disclosure on MFRS 17 in the next analyst deck. We will organize a session on MFRS 17 alone for analysts before our next results announcement, because we will move towards only MFRS 17 numbers for the next quarter. So it gives you enough time to understand the transition, because it doesn't make sense to give 2 bases and confuse people when eventually the numbers have to be based on IFRS 17. We are 4 months away from the conclusion of our 3-year strategy. The team is working very hard. We remain focused. We are putting that final push to make sure we deliver what we promise. I remain extremely committed to what I promised to you. And as we've done in every quarter, we will continue to tell you what we are doing. Thank you so much, and I will open it for questions.
Okay, thanks, Rohit. We're going to move on to Q&A. Please state your name and organization so we know who you are.